Hello, this is the Advanced Projections June 2021 report. Since our last report, the administration has continued to make progress with its solid and proactive program of slowing down and then eventually eliminating the consequences of COVID through vaccination. COVID vaccine doses are currently in very broad and deep distribution nationwide, with at least 63% of the vaccine-eligible population, about 175 million people, having received at least one dose of vaccine. Full inoculations have now reached over 52% of that same population, and 12 states have reached 70+%. The large infrastructure restoration and improvement package remains under negotiation, with the gap between political positions narrowing somewhat. Real estate prices continue to advance sharply in upper-end housing, and that trend is likely to continue throughout the summer as low mortgage rates and short housing stock supplies persist. Recently depressed housing start data suggests that new homes will remain in tight supply and at elevated prices due to material cost issues. April and May showed artificially high consumer price index comparisons due to a compressed comparison value from April and May of 2020, which has boosted talk about the impacts of expected inflation. The Federal Reserve continues to claim we will see only a temporary bump in prices lasting perhaps 1 year or so. We should see figures confirming the onset of inflation at the end of the second quarter. We probably have all noticed price increases for gasoline, some food items, and real estate through the first quarter of 2021 and into the first month or two of the second quarter. April and May core inflation numbers did spike up, and we expect several months of numbers which the popular financial press will claim as scary. It's not something we at AP are going to worry about yet, as there is good reason for us to expect price moderations and declines towards the end of the year as material and labor supply imbalances work themselves out. Oil and liquid fuel prices are expected to decline by 2022 per the EIA. Margin borrowing again hit a new record high in April, up another 3%, and its growth is anticipated to continue for the moment. The party in equities continues almost unabated. Over the past 2 months, we have said there was nothing visible on the horizon that would pierce the bubbles in the equities markets, but that caution was still warranted in taking personally huge positions in markets which are outrageously risky from valuation standpoints. During April and May, the Fed, the Treasury, and the popular financial press have begun to discuss what might cause the Fed to begin lifting short-term interest rates off of zero. The initial inflation numbers, along with modestly improving employment numbers, could induce the Fed to first change their rhetoric, then their actual policies. For example, the Fed has already announced that they will unwind their corporate bond purchases made during 2020. Now, these are a trivial $13 billion, considering they had committed to buy up to $4 trillion if necessary. So there will be no visible effect on the money supply from this particular activity alone, but it does reflect a first baby step of a wind down. As we have said in our last 7 months reports, Recession 2020 technically ended in the past fourth quarter. There have been continuing improvements in expectations for better days ahead, still accompanied by volatile but moderating speculative excesses in the equities markets as well as elsewhere, such as in cryptocurrencies and some precious metals. Due to recent actions by China and also by Tesla, both against the leading crypto Bitcoin, the overall cryptocurrency markets have had a significant setback with, quote, value, quote, losses exceeding $1 trillion during May. Now, this may be the second crack in the mirror of excessive speculation due to this large setback in what is largely a peripheral and non-productive financial activity. Now, here's the underlying socioeconomic situation. We said last month that our expectations for COVID cases and fatality tolls would continue increasing for many months into 2021. Fortunately, we have clearly outrun our fourth wave in the USA as new case and fatality numbers have dropped from recent peaks, but we are still at the top of both the global lists for total cases and total fatalities. In spite of having only 5% of the global population, we still have totaled nearly 20% of the global cases and nearly 17% of the global fatalities. As of now, June 8, 2021, total U.S. cases have only increased by about 400,000 since last month, compared to more than 4 times that amount in each of the previous 2 months. New cases have declined significantly to recent averages below 10,000 per day. U.S. fatalities have reached just past 600,000, up approximately 6,000 in the past month. If we use the reliable ratio of total fatalities divided by the total number of resolved cases, the fatality rate is flat at about 2.1%. Still a 25% decline in that grim statistic since the beginning of the year. The major accomplishment has been to reduce the daily fatality numbers down below 500 per day. This rate is now re-entering an area of societal tolerance, but should continue to move lower if the goal of getting 70% of the country vaccinated by July 4th is met. Recent slowdowns in vaccination rates in certain states are discouraging. Offshore, the situation is still dire in many places. There are large shortages of critical care capacities and vaccines for distribution, attributable to several errors in approach, planning, logistics, as well as manufacturing capacity limitations for equipment and vaccines. Globally, cases have reached 174 million and higher, up almost 20 million in May. At this moment, if there are more than 400 to 500,000 new cases being reported daily. Global fatalities have now solidly reached past 3.3 million, reaching far past our April prediction of 3.1 million. Argentina, Brazil, and India continue to show very dire and increasing stresses from the pandemic. The UK may delay a reopening milestone currently set for June 21st due to the emergence of the Delta variant there. So far, the existing vaccines appear to protect against the known variants, but the new variants are appearing to be more contagious and more harmful amongst the younger folks under age 45 than the initial version of the virus. Moderna has said that they are already working on a booster vaccine to help with further protection against variants, the first such pharma company to fully commit to developing this booster. A fatality model we have been using since it was created last November and have then been modifying periodically showed the danger in letting the pandemic continue its havoc here in the U.S. At the beginning of March, we were still running above this original projection in terms of actual fatalities versus the model. So we would have to wait and see for another couple of months if the problem is truly being solved, as would be evidenced by actual fatalities declining below the model's curve. Now, in our written report, we've updated this chart through the 2nd of June and provide it for viewing. We can now be far more optimistic regarding improvements, seeing that new fatality totals now fall solidly below the curve, with even better expectations for the coming months. This is one AP prediction that we are particularly happy to have confirmed. June results, as we predicted, now demonstrate a clear gap between actual and the original prediction curve. We hope for continuing domestic deployment of the vaccine with some expanding public acceptance of the necessity of being vaccinated based on new pleas and incentives to those still holding out. If there is no unwelcome turn of events, our July report will hopefully contain the last extensive references and charting of COVID's domestic consequences. Now, the rest of the current economic environment is as follows. In May, unemployment levels moved down moderately to a national level of 5.8% after a stronger monthly gain of 559,000 new non-farm payroll jobs, doubling April's weak number. New applications for benefits have also moderated. We have already been anticipating that return to work gains would flatten well below a full recovery level. This is consistent with our view that job gains will continue to return slowly, now taking 12 to 18 months more to erase all of the remaining job losses created by the pandemic. Many of those old jobs are now permanently gone, and newly created ones will be required to fill in the gap. Many businesses are reporting an inability to fill newly open positions, and our interpretation is that the people currently unemployed are either not located or qualified to fill the positions that are opening up at this time. Both of these situations require time to resolve. Some of the country's largest employers are committing to increase wages and benefits to help fill their openings. So we have two charts here from the U.S. Bureau of Labor Statistics, which show these modest gains in employment and the dip below 6% for the unemployment rate. Now, this presents a challenge to the current administration and Congress to move forward more aggressively into recovery planning and programs. The currently discussed infrastructure plan for America could certainly help with long-term employment improvements. One can use a nominal figure of 4% unemployment as a target for the Federal Reserve to consider a gradual end to their highly accommodative interest rate and money supply policies, beginning in mid to late 2022. We expect a decline in unemployment to below 5% will trigger a change in Federal Reserve rhetoric, signaling that we should expect to see an end to their current accommodative policies and associated near-zero short-term interest rates. S&P 500 earnings for the first quarter exceeded estimates for 86% of the companies in that index. Second quarter earnings reports are anticipated to be ahead of recent expectations, with little evidence of any systemic weaknesses. The first 2 months of the quarter have already set a record, beating all similar periods since 2002. Year over year, second quarter earnings for the S&P 500 could end up well over 40%, which is strong given the circumstances, but is hardly anywhere near the amount that would justify the leap in equities prices over that same one-year period. The following chart, courtesy of FactSet and containing our illustrative markups in red, puts this in perspective, demonstrating how much of an anticipation gap now exists compared to just before the pandemic took hold of the markets. More robust growth is expected in the second half of 2021, but projections out into annual earnings for the next year show only an 11% growth in 2022 earnings against the full year of 2021. The important point is that Wall Street is currently showing large improvements over dismal figures from the first 3 quarters of 2020, but those would be far less impressive if the COVID decline had not ever created an earnings depression in the first place. Equities market pricing has continued to move ahead, with more volatility still pushing deeper into bubble territory. Recent data suggests that equities have tended to correct 10 to 12 months after the resumption of GDP growth after a recession ends. That suggests a potential window for a correction of September to November of this year. Some trigger is usually required, such as a downward surprise in corporate earnings and/or many banks reducing their exposure to market excesses through the deleveraging of margin borrowers. The cybersecurity scares, first from the Colonial Pipeline shutdown and then from the JBL beef producer attack, put some temporary fears back into the markets, but it remains to be seen if those are anything beyond temporary blips. Both events should heighten our awareness of our vulnerabilities in cybersecurity domains and should be considered by specialists in the area as, quote, practice runs, unquote, for even larger attacks that may be politically coordinated from offshore. we believe they are not to be taken lightly, nor as isolated and unrelated events. We continue watching market performance, and continuously increasing margin borrowing levels, our favorite tool for indicating speculative excesses. Heavy margin borrowing that is synchronizing with markets making significant new highs is a likely driver for a market correction beginning soon. The latest information on margin debt is from April of this year, shown in a fresh chart from Advisor Perspectives. We had expected to see an increase during April, which did materialize at about 3%, and it is likely that May will also show another increase. Under similar margin borrowing peaks as seen in the chart, the two blue index drops of 50% of real value followed shortly after each major correction began, ahead of the last two recessions. A similar size drop now would take the S&P 500 index down to near 2,000 from its current level of 4,200. The margin debt trace has now moved above the market index, which is another early qualitative sign of increased risk. We'll discuss more about market risk here shortly. Less drastic corrections can certainly be within our shared expectations. Under similar circumstances in early 2010, the S&P 500 pulled back 13%, which would be about 550 points at current levels. In the past year, the markets have only taken one short-lived break along the way to nosebleed territory from the lows set in 2020. They are about due for another such correction, at least, but that is a qualitative opinion rather than a quantitatively driven estimate. Now, our other AP indicator information is as follows. March's closing value for the S&P 500 keeps our APSI indication as red, with that index moving further into blatantly overheated territory. Another primary indication of the top-heavy nature in equities is the widening spread between the S&P 500 and the metric shown in our graph that represents 10% of the GDP. This gap continues to grow, as shown here in the third chart. We see this as an indication that more and more of our money supply is being directed towards speculative activities rather than into solidly productive activities such as goods and services. This is our form of what is more widely considered to be the Buffett indicator, and the upper smooth curve in the graph is the boundary between a warm market and a bubble zone. Another chart here below the one we provided for the Buffett indicator, which we first showed in our March report, is also courtesy of Advisor Perspectives. It literally shouts out how risky the U.S. markets are, using a set of 4 different market indicators, very similar to our own in philosophy. The risks continue at all-time highs. The AP-MS money supply indicator remains solidly green as the Fed continues with their expansion of the money supply, now reaching $20.26 trillion, up 25% since the beginning of 2020. The $1.9 trillion rescue stimulus clearly added further to the money supply earlier in the year and was reflected in the final M2 numbers from the first quarter of 2021. One item worthy of note is that the velocity of money again declined, as the increased money supply is still not being spent at historically normal rates. Generally declining money velocity has been a fact since the days just before the Great Recession, and the M2 velocity, now at just 1.123, sits slightly above its all-time low of 1.103 set in the middle of last year. This means it now takes over 10.5 months to turn over the money supply just once, when it should normally take only about 7 to 8 months, implying a velocity of at least 1.5. We expect the second quarter velocity to remain flat, with a small upturn then in the third quarter. Recent action in gold prices show a rebound from support levels just below 1,700 in March, with a 7% move up during April, plus more in May, leading to prices now hovering around $1,900 per ounce. Silver behaved more tamely in May and remained in the mid-$27 per ounce range. Rhodium took a hard fall in late May, down to $16,000 per ounce, and then climbed right back over a third to recent levels of $20,000 to $22,000 per ounce. Platinum fell about 7% and now continues to trade between $1,140 and $1,190 per ounce. Month-end prices for gold and rhodium keep our AP precious metals indicator deeply into the red. The April leading economic indicators from the Conference Board improved solidly, pushing our AP-LI indicator a bit further into green territory. We continue to expect further improvements to LEIs during the next few months. The Conference Board also improved their outlook for economic recovery and that we should expect a more robust recovery well into 2021, so our AP-LI indicator will likely stay solidly in green territory for many months. All of this is predicated upon the absence of any overwhelming equity market correction or a sudden worsening of unemployment during the upcoming months. We eagerly await newly redesigned LEIs from the Federal Reserve as a way to confirm the data we currently use, but so far, the Fed has been mum on any future release date for these new LEI calculations. Our AP-YC yield curve indicator continued green, now for 4 months, the first time since May of 2018. The yield curve continues moving all on its own, maintaining a more normal shape, with the short end firmly anchored near 0%, but the long end up well past 2% for the 20 and 30-year treasuries. Small noise moves showed up in the shorter terms, with the 5 and 10-year yields both holding essentially constant over the last month. The Fed still has little room to do anything on its own with short-term interest rates to further stimulate should it become necessary. If inflation pops up harder or longer than they expect, or if a further expansion of the equity bubble becomes worrisome, the Fed may be forced to react, raising short-term rates, which would likely collapse the equity bubble, assuming it does not already do so under its own weight and imbalance. The first quarter 2021 GDP grew substantially upwards from its enormous decline in the first half of 2020, with the traditional measures and definitions of recession having already indicated a technical end of recession 2020 back in November of that year. Still, though, neither the NBER nor the Federal Reserve have yet to take official notice or acknowledgement of this technical end, despite our own months-old declaration that the recession 2020 had ended approximately 8 months after it began. We're starting to wonder when the NBER will make an official call, as they are terribly behind the actual course of events. The Federal Reserve's aggregate measure of economic stability remains in a position of relative safety, but the Fed continues to stay with the NBER declaration of recession within all of their data sets. Therefore, our APFD indicator for this report artificially remains red, now for a full year. Note that this may change soon if the NBER and the Fed finally and retroactively acknowledge the recession's end in the fourth quarter of last year. Now, we maintain a cautiously higher optimistic stance here. The economy is coming out of its COVID coma. Restrictions on business and social activity are rapidly dropping by the wayside, and the barely noticeable fourth wave of COVID infections has already gone away. That assumes that what is going on in the rest of the world will not push something unpleasant back into the U.S. There's a more normal political environment, which of course has both positive and negative elements to it. Market and investor anticipations of this return to normalcy may continue for many months, but increased dynamics and volatility should still be expected. So in summary, We calculated that the actual onset of a recession had begun just over a year ago, a fact which was then confirmed by the NBER in June of 2020, and it became officially acknowledged by the Federal Reserve later in the summer of 2020 with their adoption of the NBER's declaration within the Federal Reserve datasets. However, as we have frequently noted, the technical end of recession 2020 already occurred by the mid of the fourth quarter last year. 3 of our indicators are now in green territory, and a fourth technically should be green also, the APFD indicator. And we reflect this in our again lowered probability of another near-term recession to only 30%. It would be even lower if the equities markets were more tame in their behavior. We are now entering a period in which our standard 6 indicators can be relied upon again, but still we have to augment them by a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several more months. Those are inherently less reliable short-term indicators of recession potential than the 6 AP indicators. We continue to maintain that this is a very risky market environment, equity market environment, with the potential for significant and protracted drops or flash crash scenarios based upon the disparities shown in our charts over the past several months and again this month. Only those with the highest tolerances for risk should be speculating in the equities markets at these levels. High speculative valuations never persist, and a return to the mean or worse becomes more likely with any new unexpected disruptive influence. The cryptocurrency sideshow has now provided ample evidence for this viewpoint. The only moderating influence in this scenario is that the Federal Reserve has continued to state a longer-term, near-zero interest rate environment, and that continues to fan the fires of market speculation. This situation could persist for up to another year, or some new, perhaps black swan event could arrive to pop this bubble in short order, such as more serious forms of the recent collapse of the Archegos Capital Hedge Fund or the Colonial Pipeline and JBL cyber attack shutdowns. On the other hand, history may repeat itself in that we could expect to experience another roaring 20s as public confidence, optimism, and spending take over once COVID is finally behind us. Despite the glossy economic reputation of the 1920s, there were 3 recessions in it before the big one hit in 1929. This time, a more responsive and proactive Fed and a hands-on administration could improve our prospects for sustained economic gains over the coming decade if we can avoid disruptive political detours along the way. So that's the end of our report. We expect another long one in July as we wind up the COVID story. And after that, our indicators should also allow us to make more brief reports, more concise summaries of the economic situation. And we hope that the promise of that, as well as a much more enjoyable summer this year, will lead you to have a good time this year. This is the best from Advanced Projections to you, and we will talk to you again somewhere near the middle of July. Thank you.